I feel like it's not a surprise, but you guys are finding adjusting entries to be kind of hard, just because there's lots of little rules and there's the money there, it's not there. So if today makes you more confused, trust the process. Know that we're going to do it with problem A, problem B. It'll be on the practice test. And what we do today, there's going to be a very, very similar problem on the actual test. So my goal for you is that you become bored with it because you get it. But we're going to keep doing it until you're all at the boredom point. Throughout the chapter, we've been talking about why time is an issue and why our trial balance is really not the true story. The debits and credits might equal, but it's really not the true story because we've used stuff over time. And we learned that there's accrual, there's deferral, everything involves income statement and balance sheet. So we've done some transactions. Now we're really going to put them to work and do this final where we still have a trial balance, but it's got a new name, the adjusted trial balance, because it happened after the adjustments. So an adjusted trial balance by definition is prepared after the adjusting entries have been both journalized and posted to the general ledger. The purpose of it is to truly say, okay, yeah, the debits and credits equal, but these are the real numbers. These are the numbers after we've said the pens are gone and after we've used up a little bit of our insurance and our employees have worked but we haven't paid them. All of those things that we did in that last section, now it really truly is a real balance. And the whole purpose of doing these adjusting entries is so our financial statements are as accurate as they can be as well. So that's what we're going to do in today's activity. This isn't in your notes, I don't think, but this is just such a great recap. In Chapter 2 versus what we're doing in Chapter 3, I just want to give you a little roadmap. In Chapter 2, I taught you how to journalize, and we post to the general ledger. And from the general ledger, those balances create what's called a trial balance. That's what we did last chapter. In this chapter, we know that the debits and the credits might have equaled. They did. You got totals at the bottom of that trial balance, but it wasn't the true story. It's really why accounting can be tricky because sometimes your debits and credits can equal, but it's really not the true story. There's more to the story. So that's why in Chapter 3, we journalized adjusting entries. One thing we won't do is this process. We're not going to post to a general ledger. Oops. They're just going to give you balances. All of those updates will be given. Okay, so it's the book's way of saying you did it last time, so we're not going to keep doing it. Just know that that would have been part of the process. We journalize, we're just not going to go post. But we are going to make an adjusted trial balance. The debits will still equal our credits, but this is the true happy ending. This is the true story because we've adjusted for all that stuff what was used and all the stuff that happened over time. Here's what an adjusted trial balance looks like. It looks identical from a formatting perspective to a regular trial balance. It's just that we've got some new accounts. Before we didn't have salaries and wages expense or rent, supplies expense or rent expense or insurance expense or interest expense. We didn't have those because we hadn't done adjusting entries yet. The reason there's some things in red is that they changed. Supplies changed from whatever we purchased them initially down to $1,000, and as a result, we have to have an expense account to go with that. So it's basically the same format, it's just adding some accounts and the numbers are going to be different. We then take the numbers from the adjusted trial balance to make an income statement that falls into the owner's equity statement that you in turn can make a balance sheet out of, just like what we did in Chapter 1. It's just that we're using more accurate numbers. I don't want to get you all confused, but you take this adjusted trial balance and you just go put the numbers where they should be on the balance sheet, income statement, and owner's equity statements. If I go back to this page for just a moment, we have to pull what goes where. So I see cash, AR, supplies prepaid. That's all balance sheet stuff. Because I see assets, I see liabilities, and I see owner's equity. Revenue and all the expenses are what go in the income statement. So we start pulling those numbers and building financial statements. So that's all I want to talk about. We need to spend more time doing. Ooh, this is a typo. 313 and 314. The reason I want to do these in their entirety is I look, not that I want to teach toward the test, but there's a problem like this exactly on the test. But we're going to do it many, many times until you get it. Okay. You technically wouldn't need your book because the handout I just gave you is an excerpt from the book. You will, however, want to go find the workbook pages that go with all of these. There should be a workbook page for exercise 313. Just a boring old general journal. You are welcome to write all over this. What this is asking you to do, and you're going to see the same thing if you are happen to looking at the book, it's just saying prepare the adjusting entries that were made. We have two trial balances here. We have the one that's before our adjustments. I guess I don't have this digitized for you, but we have our before adjustments and our after adjustments. And if you look really closely, they're different. Not all of them, but anything impacted by an adjusting entry would be different. A note that I want you to put on this handout that I gave you, write somewhere on there, look for differences. You're going to find 12, which would equate into 6 adjusting entries. I'm going to do them with you until you're confident enough to try them on your own. You are welcome to write, you're welcome to draw, you're welcome to circle, whatever it would take. Right now, I want you to try to find star, dot, dash, do what you need to do. Try to find the 12 accounts that have a different after the adjustment balance than they do from before. I'll give you the first one. Cash is nothing. AR changed. So that's one of your 12. So try to find the 12 that differ from the before column to the after column. Did you find 12? Okay. So now we need to start finding their partners. Let's do an easy one. Supplies. We started out with $2,300 worth of supplies and what? Down to $900? Why is that? We used them. What's its little partner? Supplies expense. Now here's where things get kind of cool, if accounting can be cool. That, okay, supplies and supplies expense should be the same difference. Like for example, I see we started with 0 for a supplies expense and it grew to $1,400. Is that what 2,300 minus 900 is? Well, bam, we found our first partner. So we have to journalize that. And I think, oh, I guess it wants to go in order. I suppose we can play nice. I just like to start with supplies because they're easy. AR went up. AR went up by $2,000. When we adjust with AR, what's its partner? Service revenue. That means we did some work for a customer it is an accrual revenue adjusting entry because they haven't paid us yet. What I would do, and I'm going to actually write on mine too, I am going to now cross off AR and I'm going to cross off service revenue because I know I did those two. And if it would help for you to do something like what I just did, like tie them together on this page, it's a really nice way for you to review the like little partners. And if you think about it, maybe you guys should do this too. Sorry I don't have this digitized. That's really annoying. Draw a line under owner's capital. Above the line is balance sheet. Below the line is income statement. Something like this. I think it would help because we know we're going to do six entries. We've already done one. We have to pull one from balance sheet and one from income statement. It's under owner's capital, above service revenue. Okay, our next one, supplies and supplies expense. I want you to all of a sudden feel like this isn't so hard. Maybe you like it in this format better. Maybe it's a light bulb day. Some of your light bulbs are going to be like, but bam, I get it all of a sudden. So we see supplies expense go from 0 to 1,400. And lo and behold, 2,300 minus 9 is 1,400. And it's a really nice way for you to double check income statement, balance sheet. I am writing the type of account out on the right margin, or the type of adjusting entry. It's deferral because money was there to buy those supplies and now they're gone. Time has passed. As I go to my next one, I see prepaid insurance is an asset that's had a $4,000 balance, ended with a $2,500 balance. Why? I own that asset. Why is it gone? Time passed. What income statement account are we going to use? Insurance expense, which remarkably goes from 0 to 1,500. Maybe again, it's all of a sudden clicking. Should we talk about overstated, understated, or is that too hard and annoying? Think about if we didn't do this though. Assets would be overstated because it looks like we, on paper, if we didn't have this column, you can see it happening on paper now. It would look like we have $4,000 of insurance when really we only have 25. So that's where the overstated comes from. It's a deferral because we bought that insurance on the front end and then as time passed we used it. Accumulated depreciation, hold the show. Equipment started at 14,000, ended at 14,000. There's a dirty little secret attached to that equipment though, and what's it called? Not accumulated depression, accumulated depreciation. Okay, so the story is $14,000 equipment, great. I literally want you to think of this equipment like you've got something tied to your bumper and it's like dragging the value of the equipment down, and every month that thing gets bigger and heavier because it's offsetting the value. It had, accumulated depreciation had a $3,600 balance. It increased to 45. The cool part is you can look down under depreciation expense. That's a $900 difference. It's a really nice way to check your math. So we see expense debited, accumulated depreciation on equipment credited. Riley asked this question yesterday. This is not a 3-line entry. It's just my answer key being obnoxious. I would be cool with accumulated depreciation equipment. Accounts payable remained unchanged. Salaries and wages payable went up. We started at 0 and 1,100. Tell me why. What is this about? We changed our fiscal year. interrupted the pay period. Well said, Ben. Our employees worked. They're not going to get paid, maybe they get paid every other week, and that happened right in the middle of that fiscal year change. So we owe them money. We have to expense out what they did, and we owe them $1,100 eventually. And as workers, people getting their paycheck, we don't even maybe notice this, but I am certain if you are ever on the other side of that paycheck, you definitely notice that. Owner's capital stayed the same, and we see service revenue go up. Whoa, we earn more money. Why do you think that is? Oh, I skipped one. I got too far down the list. Service revenue went up. What liability went down? Unearned service revenue. The Minnesota Viking ticket thing. The Vikings must have played a game. Okay. I think they're earning more revenue than that at their games. But you see a liability go down. Unearned rent revenue went down. And service revenue went up. Sorry, not service, rent. Rent. What that means, and the reason it's a deferral, the money was paid to us up front. We might have said, hey, we've got some renter up above. We own the Thrifty building. We say, hey, pay us 3 months in advance. But then as a month goes by, we technically provided our work. So that liability of giving them apartment to live in went away. I don't need a show of hands, but I can just tell a body language change in some of you. All of a sudden you got it when you see this side-by-side business. That's what it's going to be like on the test. For those of you who are like, this was made me more confused, we're going to keep going. We'll keep going and keep going and keep going until you guys get it. That's the adjusting entry part. In a real accounting world, they'd hit post, and it would literally suck those debits, suck those credits, those accounts over to the general ledger, and it would all of a sudden update. That would shoot out a more accurate look at our debits and credits, because we can see side by side they were not the same. This is the debit and credits true story. So do you see how we're omitting that post general ledger, make an adjusted trial balance step? We're omitting that, and the book is just saying, here it is. Because you guys know how long posting takes. Ugh. And so the book said we're going to just skip that step. Here's your new balances. The debit's still equal to credits. Problem is the debit's still equal to credits the first time. It's just that we did a lot of little number tweaks because we use stuff. So now we would take this after the adjustment. Those are all the general ledger balances. And now let's shoot out 3 financial statements. Do you remember what order they go in? Way back to chapter 1. Let's do income statements first. Yes. Then what? Owner's equity statement. Yes, they get their share of net income or loss. Can you tell by just looking at this if they have a net income or loss? You should be able to. We have some revenue. What kind of revenue do we have? Service and rent. 36 plus 11.9 minus salaries and wages minus supplies expense minus rent expense minus insurance expense minus depreciation expense. Just by looking, they're math gurus. Do we have a net income? Okay. The owner gets that share of net income. What will the owner take as a hit though? Do we have drawing on there? We don't, but usually there'd be some drawing that they withdrew from the company. And then we can tell asset liability and owner's equity story. Let's try this. You should have 3 financial statements in your books. Are they there? Bottom of page 92 over to page 93. We are going to use the balances from this after adjustment column. You could do the before adjustment, but that's not the true story. That's why this chapter exists. These are going to be the numbers we pull to make these three financial statements. Cross country guys, I'm trying to run through this, no pun intended. Okay. So funny, I know. All right. We're not going to start talking about merch, so we're going to just go. Okay. Income statement, please put that somewhere on there. If revenue exceeds expenses, you have a net income. Most of the work we do in this book is net income. Rarely does it talk about net loss. I don't know what kind of smoke and mirror world these authors lived in, but a lot of times businesses experience a net loss, but they're trying to make it easy for you, I guess. Do you have a left and a right column? Why do you think we need that left column? And then shove those totals over in the revenue in the right column. For the first time in a while, we have two types of revenue, don't we? A lot of times in chapter 1, we only had one. Does it say the word revenue for you? Oh, they make it so easy. The reason we're going to use the left column, as Riley beautifully described with sound effects, we can and then throw that over into the right column. Would it matter which one you put first? I'm not so picky on that. When there's only 12 tests to grade, I can manage if it's flipped in order. Why are we using the left column though this time? We have how many revenues? 2. So it looks like, so just like imagine the old Thrifty building. Their Thrifty White Pharmacy and Gift Shop was a revenue producing entity, but then they had apartments upstairs. So that would be 2 different line items of revenue creating events. 17,100. Are these numbers different? What? Everett? Oh. Here we are. Here we are. Go. Go. Woof. Okay, so 36. Is this the right one? Yes. Why are we not listing the 34,000? Why are we listing the 36,000? Because it's where we are now. It's after the adjustment. Very good. So 36 plus 11,9. I don't want you to put total revenues where my answer key did. I want you to put your 47,9 over in the right column. 47,900. Why do we have more expenses all of a sudden? We started with 0 balances, and why all of a sudden we have these expenses that show up? We use things, and we have to expense out as we use things. Again, I don't necessarily care what order you put these in. You're just pulling from the after adjustments column. As far as all this indenting goes, you don't have to double indent. Sometimes it helps if it's slightly indented. I don't know. Take my answer key with a grain of salt. Do what works for you. We do have more revenue than expenses, not a ton, but our revenue exceeds our expenses. Hence the reason we will yield a net income of $11,000. Be mindful of your rulings. I've got 3 single rulings because we've done some math, but when we are done with that 11,000, that's where the double ruling occurs because we are done with our math. If Jen Salvi has enough highlighters for all of you, or if you have your own, here's where you'd want to highlight that $11,000 because that is going to get time warped sucked over to one of the other financial statement that we're about to do. It melts my little accounting heart when you use highlighters then on the real test, because it's like, oh, it mattered. The act of highlighting it, it just sticks with you. Who's going to get $11,000? Hint, look at the next financial statement. The owner gets that little share of money. We're going to see some other things happen to the owner if that in fact was going on. I don't think it is though. Owner's capital, comma, beginning. I don't like when they put the dates. I like just beginning and end. If you're fine with dates, great. But owner's capital, comma, beginning. Where are we going to get that number? Owner's capital and the adjusted trial balance. So that owner for the year of 2014 brought in $15,600. You will find out in a future chapter that's what's called a permanent account. I would say there is one thing we add, there's one thing we subtract, and then there's one thing we could potentially add, one thing we could potentially subtract. Had the owner invested more money in the business, that would have been a plus investment. Had the owner had drawings, it would have been a minus drawings. Is this starting to come back to you? We had neither. There was not a plus, there was not a minus. The one little wild card, if it's net income, it's plus. Had it been a net loss, it would have been minus or a hit against the owner. The only thing that changed the owner's worth is that plus 11,000. Notice I pulled that from my old highlight. That's where that number came from. You just got done highlighting to equal the owner's capital, comma, end of 26,600. Single and double rule, as I've noted there in blue. With the same or with a new highlighter color, take that 26,600 and where is that going to get teleported to? Hint, it's your next financial statement. The balance sheet. Do you have asset and liability headings? Sweet, owner's equity. We are pulling these from the adjusted trial balance. I think seeing that little line that you drew helps. Can I just show it all to you? Oh. For the first time, you are using a contra account on a financial statement. So just notice what that looks like. It's why they use that left column, because our equipment's valued at $14,000, but then you say minus the contra account to equal its like real balance. We're still driving around in our beep 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 $14,000 thing. It's just got that nasty $4,500 chunk of accumulated depreciation hanging off the bumper. Because of the nature of ALLO, assets equal liabilities plus owner's equity, we are going to stop to single and double rule there, just like we did in chapter 1. They sure had you do that. It's my answer key being inconsistent. The reason they had you shove all of those on the right is because this was just a little bit of math that needed to be done. Yeah. As long as you can make sense of it, whatever works best for you. 34,100 is kind of that magic number we're shooting for now at the bottom half of this. Because if I had to stop and say all the way across, the assets equal what's about to come. We have quite a few liabilities, and really owner's equity just has one, and it's being pulled from up top. I know we're getting close to the time where a couple of you have to go, so I want to just show you all of this. I personally would have used the left column here to itemize the liabilities. You see, again, my answer key being pretty inconsistent. Again, this 26.6 is being pulled from a previous financial statement. What are our thoughts? I said it was going to be hard. Makes way more sense all of a sudden. I can tell a body language change in you guys. I just thought you'd kind of freak out about doing 3 financial statements, but you're doing okay. So here ends chapter 3. Like, we did it. Lectured, did a lot of work in between. Plan for tomorrow is together we're going to do problem A. Monday in class you'll do problem B. Won't be homework. I'm going to be on my way to Dave. So it's actually a perfect timing. We would have done problem B in class whether I'd have been here or not. So I'm going to stop the recording. If you have additional questions, though, I'd love to answer them.